So yeah, I'll talk about our views across the metal space. I'll run through them reasonably quickly, so do catch me afterwards if you want to ask any more details on any of them. So starting off on the macro side of things, obviously the macro picture, I think those of you familiar speaking at a few one-to-one events last year, we've been quite constructive that Beijing's loosening policies were going to be quite positive and 2019 would be a good year. Obviously, through second half last year, there was a lot of skepticism about that, a lot of negativity and concern, impacts of the trade war, etc. But I'd say finally, last couple of months, Beijing's really strengthened its messaging around the economy, certainly the infrastructure stimulus very clearly happening. You see the strong new lending data, record new lending in January. We know 500 billion RMB of that was bonds issued just to fund the infrastructure increase. And just general macro loosening as well. Obviously, MPC meetings pretty positive in terms of tax cuts and just talking up the economy. So things are moving in the right direction. I think confidence in China is starting to re-emerge, and that's certainly been helping this kind of upward drift in metals prices we've seen since the start of the year. One of the key risks, however, remains very much on the housing market. The Chinese housing market has become extremely reliant on essentially government funding. A shanty house redevelopment program that started in 2016. You can see the jump in China's housing sales, kind of floor space development numbers last few years has been entirely driven by Beijing's activity. So central government today is around 20% of the housing construction in China. Now, those of you who've heard me speak before, long-term demographics for China are certainly not conducive to higher construction activity. Right? China has built so many apartments in the last 2 decades. Floor space per capita is over 30 square meters. That's kind of the highest level in Asia. And the negative demographic profile through the 2030s, the question of how much they can sustain in terms of the annual floor space development, it already looks seriously overbuilt versus our previous views. I used to say 5 years ago, we think the sustainable floor space volumes for China's construction activity are around 1 billion square meters a year. And last couple of years, we've been over 1.6 billion square meters. So, shanty house redevelopment started in 2016 as a destocking policy to support the housing market, continued through 17-18 to continue supporting construction activity. But this year, Beijing is looking to wind that policy down from 5.8 million units last year to 4.6 million this year. So that would be a 20% decline in the 20% of construction that Beijing controls directly. And at the same time, the private property market is also weakening quite rapidly since the fourth quarter of last year, sales falling at a double-digit rate, prices coming off as well. So even if they do loosen policy enough to support the housing market and stop it falling too sharply, very clearly construction is going to be a negative for this year and quite potentially a bigger negative for 2020. So that will partly offset that acceleration we're seeing in infrastructure and from the general broader macro loosening. So to start with, on the ferrous side of things, our story on ferrous is very much strong first half, weak second half. So we think near-term demand will do well as infrastructure gets traction. And equally, like I said, housing is slowing, but conversely, a weakening property market in China normally means you see an acceleration of construction activity to start with, and then a more rapid weakening later on. Because in China, you can't really sell property off plan. Projects have to be 50% complete to get the sales license. So that means today, developers are pouring concrete as fast as they can to get the sales license before the market weakens further. So I think first half steel demand does very well, but we will really start feeling the impacts of that housing slowdown in the second half and into 2020. So, steel inventory, that's following the normal seasonal trends there. That chart's a couple of weeks out of date. Last couple of weeks, we've certainly seen a decent inventory draw, construction activity starting to lift as it does at this time of year. So everything we see on the demand side looks quite comfortable. And then obviously the feed through to iron ore, seen a huge number of headlines recently following the Vale accident in Brazil. So fundamentally, iron ore last year was already a very tight market. It was the tightest market that we've seen since 2013. Reasons for that: seaborne iron ore supply fell last year for the first time in nearly 20 years because all of the majors were having issues. And also India, that's a supplier that we've lost. Early 2010s, India was exporting 100 million tons a year of iron ore. Last year, India was an importer of iron ore for the first time because they've reformed the steel industry, but the mining industry still have a lot of export bans, a lot of mining issues in a lot of states. So seaborne iron ore supply already tight before the Vale accident. And domestically as well, the mining supply has been much reduced versus history. So this is why we think iron ore prices, they're already up at $85, but we really think they can hold at this level now for another 3 to 6 months while the steel market is doing well. Fundamentally, though, as steel weakens in the second half, iron ore won't be immune to that. But the iron ore market fundamentally today is very different to what we've seen in the last 5 years. We've lost a lot of that elastic supply. In the old days, if prices spiked $20, you'd see Indian shipments, you'd see Chinese private mines switching on very rapidly, lots of supply coming into the market. But we're not going to see that this time. Like I said, India is now a net importer of iron ore. They don't have much ability to increase their exports. And on China, the biggest structural reform we've seen, everyone talks about supply side reform in steel, coal, aluminium. Yes, that's been one issue. But the biggest issue for me on the way China has changed in the last couple of years is the clampdown on the domestic mining industry. This has been a huge story for iron ore, bauxite, manganese, zinc, lead, so many commodities, where in the old days the marginal supply came from private, small scale, often not fully licensed mines in China, which were generally low grade, cheap and cheerful. If there's a margin to be made, they operate. If they lose money, they close very quickly. We had this very elastic supply, and there was an abundance of it. So that would always respond to the price signals. Whereas since mid-2017, China's had a big HSE, health, safety, environment clampdown on the domestic mining industry, and that has removed so many mines from those markets. So those small-scale private mines, licensing is very difficult now. Beijing doesn't issue low-grade mining licenses anymore. And if you want to continue operating, you need to invest so much in environmental upgrades, in safety facilities. That's a big change in the way these things used to operate. They used to be very much at the margin there to make a quick buck. But now you've got to do everything properly. And if you screw that up, if you have an accident, you're in serious, serious trouble. The consequences these days are much more severe than they used to be. So essentially, we've decimated those marginal cost curves. So iron ore, bauxite, manganese, zinc, lead, all of those commodities really impacted by this story. So last year, domestic iron ore output fell 7% to 240 million tons. On our 2017 iron ore cost curve, we'd have said $70 iron ore would give you over 300 million tons of domestic supply. So that story, has really changed, and we don't see that domestic iron ore supply coming back in a big way like it used to. So fundamentally, if Vale is losing 30, 40, 50 million tons of supply, we can't see where the offset to that will come from in the near term. No India, no China. So from that perspective, iron ore is going to stay very tight while steel's doing well. Iron ore prices do well first half of the year, but as steel starts to feel the construction slowdown in the back end of the year and into 2020, we'd expect iron ore to be falling back towards $70 and then lower from then on. Structurally, iron ore is still the worst commodity because of the scrap cycle in China. The fact scrap is starting to emerge. That means China's building a lot of EAFs. They'll be using a lot more scrap going forward. That will be cannibalizing the iron ore demand in the years ahead. Moving on to the non-ferrous side of things, lots of interesting stories here. Copper, certainly our favorite. I know every analyst loves copper. I was just looking through the Assay magazine, actually. I see all the articles on copper there, universally optimistic. Zinc as well, short term, we think looks good. Manganese is another one that looks very good. And ones that aren't looking so good at the moment, certainly aluminium and nickel as well, and the battery space as well still looks quite comfortably supplied. So on copper, we've had a big inventory draw in the copper market last couple of years, 600,000 ton decline in visible inventory last year. And on the mining side of things, copper is finally tightening up. Now, I've been an analyst for a long time. I was kind of working in the banks since the early 2010s. I know sell-side analysts have been promising a deficit in copper for the last 10 years, but it is finally starting to emerge. Cobre Panama, last big mine, ramping up this year. Very little supply growth otherwise. And every major mining CEO has told you for the last decade they love copper, but none of them have got any good projects that they've been investing in. So they finally started to trigger the investment cycle, but none of those are going to be delivered till about 2022, 2023. So we know copper mine supply growth these next 3 years is minimal, and existing ones going backwards. So we've already seen, since the start of the year, TCEs Q4 last year up at $95. Chinese set the annual contract at $80.80. Looked like the miners had got a good deal, but already spot TCs are down in the low 70s today because of that lack of mine supply growth, Chinese smelters trying to ramp up production. And that's really tightened things up. And the most bullish story on copper, which is less well understood but starting to come through to the market a bit more clearly, is what's going on the scrap restrictions. So this is not just a copper story. This is across all commodities, right? That China is trying to import less and less of the world's garbage, as they put it. So we've seen huge disruption to the global paper and plastics recycling industry as China's stopped importing those. And the draft law says at the moment from 2020, 0 imports of any foreign waste material whatsoever, which fundamentally should include all metal scrap. And we saw Customs has already introduced rules from July this year restricting all scrap imports. So the question for most metals, steel, aluminium, not such a big deal. China's scrap imports are quite small. Rest of the world can absorb any scrap that China doesn't take. Whereas for copper, China has been importing copper scrap for the last 20 years. It's massively reliant on copper scrap imports. Last year, even as they wound down Category 7, the low-grade scrap imports, the imports were still 1.2 million tons. It's over 10% of China's copper unit supply. So we don't think that copper will be banned. We do think there will be some kind of exemption. Lots of talks going on at the moment and discussions about reclassifying copper scrap as a resource if it's very high quality. But certainly scrap will be reduced a lot more end of this year. And that's just going to add that tightness. We have no mine supply, we have reduced scrap supply, and equally we don't see anywhere else in the world that scrap can get diverted to, because everyone's been selling the scrap into China for the last 20 years. There's no spare scrap smelters outside of China that can take that material. So copper looks extremely tight from the supply side of things. It's our favorite commodity, through the year, and certainly structurally over the next 3 years. Another one that's quite interesting at the moment, zinc. Obviously, zinc struggled a lot last year. It's done very well so far this year, however. Tale of two markets, really. You look at zinc on the supply side, the mining concentrate side. You look at that TC chart, and you're like, wow, that's, TCs have shot up. That looks bearish. There's clearly a bit more mine supply growth coming through. China, we lost a lot of mine supply growth, but by second half last year, that's kind of leveled out. And on the seaborne market, finally started to see a bit more supply coming through, Dugald River, New Century, etc., ramping up. So concentrate supply has increased, but that's not fed through to refined zinc supply. Refined zinc inventories today extremely low levels. Now, why is that? It's really just a temporary issue, right? We have a temporary smelter bottleneck in China today. So plenty of concentrates available, but there just aren't enough smelters to process it. The biggest smelter in China, Juzhou, closed in December last year. They're relocating to new facilities, which they'll ramp up from April. And there's a few other smelters in China as well doing some environmental upgrades at the moment. They're still not complete. So overall, you've got over 500,000 tons of Chinese zinc smelters offline right now. So even though the TCs are attractive, the mine supply is available, they just can't produce the refined zinc. So short term, we think zinc prices can still do well. Inventory is at extremely low levels. If we continue to get more bullish macro news flow, if we get a trade deal done and that raises sentiment again, zinc could continue to do well on a kind of 3-month view. However, fundamentally, we know the mine supply is coming through. That smelter bottleneck in China is very much temporary. So we do think refined zinc output will be lifting more strongly by the middle of the year, and that will probably bring zinc under pressure again through the second half. Lead is another commodity that's benefiting in a similar way. So lead, obviously Chinese domestic mine supply, that's down sharply on all of that mining clampdown we talked about. And globally as well, lead's mine supply has actually been in decline now for 5 years. That is a commodity which has got serious supply issues. And then on the environmental side as well, obviously lead was one of the first commodities to see some environmental impact in China. A few years ago, they really clamped down on the illegal secondary lead processing. So that saw a huge drop-off in China's secondary lead supply. The problem is that because lead was kind of at the forefront of China's environmental clampdown, it's now suffering the other end, where the upgrades have happened, and that secondary lead supply is now ramping up again, because people have made the upgrades, you've got properly licensed facilities, you've got environmental controls, so that secondary lead supply is actually growing quite strongly right now. So lead looks very tight on the primary market side of things, but secondary supply certainly is lifting. And on the demand side for lead, that's not as bright as some of the other commodities. Certainly on the e-bike side of things, Chinese e-bike population seems to be peaking out. You've got 250 million of them for a population of 1.3 billion people, and now obviously people are upgrading, starting to buy cars, etc. So e-bikes are not growing so well. The delivery e-bikes, though, the three-wheelers, they are doing very well. So there are about 50 million of them. They're still growing kind of high single digits every year. So there's still, overall, we do still see lead demand growing, but fundamentally, it's the e-bike slowdown. And the other thing on the e-bikes is we've seen another kind of negative for lead on the environmental upgrades, that China's been tightening the standards. So you've got declining lead usage within the batteries as they try and improve the technology as well. So a little bit of a headwind there for lead, but overall the supply side does look very tight. We still see that market pretty balanced next couple of years. In terms of some of the weaker markets on the aluminium side of things, so alumina, obviously last year, huge price volatility given the seaborne disruption. We even saw China exporting alumina for the first time in a long while. But fundamentally, again, China, we've seen this big clampdown on the bauxite mining supply. So in the old days, China's bauxite, it's lower silica generally, higher silica, lower alumina content than global mines. But it was based closer to the smelters, which are largely in center and west of China, so it was usable. Fundamentally now, though, we've had this mining clampdown. China's not using so many low-grade mines, so China will have to import more bauxite and alumina going forward. So we do think overall alumina, it's down to below $400 now. We think, low 300s, China will start importing a lot more. So not too much further to go on that. The other inputs for aluminium, anodes now coming off post-winter. Thermal coal prices been weakening as well. So overall, aluminium looks like it should be bottoming out soon. The cost compression is happening, doesn't have too much further to go. And the thing on aluminium that we don't see so well in some of the other commodities is that elasticity of the supply within China. Chinese smelters are pretty good at switching off supply when they lose money. The problem is they're also too quick to bring it back on again before they're even making money, and that's what we're kind of suffering at the moment. So last year, aluminium production actually declined in China for the first time in near 20 years. We saw a much sharper draw in the aluminium inventory, so that makes us think, that we're coming to the end of that negative cycle. Aluminium prices should bottle out, but fundamentally, we still have a major capacity overhang for aluminium. So big difference really in aluminium and steel. Steel supply side reform made a real change, eliminated lots of outdated capacity. Now you're seeing the capacity upgrades happening, but you very strictly have to replace an operating old steel mill with a new one if you want to build a new one. In aluminium, they have this replacement capacity, but by and large it's buying a capacity license from someone who closed their smelter 5 years ago. So it's not really an operating replacement capacity. On paper, it's a capacity swap, but from an operating standpoint, it's not really swapping capacity at all. So last year we had 4 million tons of new aluminium smelters that were due to switch on. Only 2.7 actually did. This year we've got 2.8 million tons of new smelters ready to go, and we only see demand growth of about 1 million tons in aluminium. So aluminium is going to continue to suffer from this capacity overhang in China next couple of years, which really limits the upside. So, demand, macro go well. We can see copper having a good run. We can see zinc and steel and iron ore having a good run near term. But aluminium will always be capped to the upside because as soon as things improve, you see Chinese smelters switching on. I think we've already seen Hongqiao and others as well mention about ramping up capacity again, just because margins have started to improve a bit. So aluminium one, we really think is capped to the upside. Nickel as well, that's one we were more bearish on last year, and certainly that kind of played out reasonably well. Prices have obviously bounced again start of this year. As a fundamental analyst, I can't really get excited about nickel short term. No, long-term EV story, yet totally a believer in that, but near term, batteries are only 7% of nickel consumption. Stainless steel is still 3/4 of nickel consumption. And the problem is we just have too many nickel units coming out of Indonesia. So Indonesia has been ramping the MPI production massively. From 0 in 2015, it's going to be over 500,000 tons by 2020. It's going from 0 to 1/4 of global nickel unit supply in 5 years. Not only are they producing MPI, they're now ramping up stainless steel. I think we've got Derlong, Tsingshan both ramping up new stainless steel facilities today. So there's way too many nickel units coming out of Indonesia short term. So yes, battery demand is great. You look at tier 1 nickel sulfate for batteries, that does look very tight. LME inventory has continually been drawing. Tier 1 Shanghai inventory, very low as well. So you look at nickel on the tier 1 market, you can see the tightness. But fundamentally, this year, next year, we still see far too much supply coming out of MPI and stainless. And that is just really going to be an overhang for nickel for the near term. So yeah, battery story longer term, totally believe in that, but next couple of years, nickel is not going to be a beneficiary. Another one we're quite negative on and remains so has been the other battery raw materials. Now, I think the problem in things like lithium is the supply has just come too far ahead of the demand, right? So yes, EV sales growing very rapidly, right? 25-30% demand growth year on year. And I personally believe the EVs in China will be a massive leader, obviously environmental benefits. One other key angle, the fact that most people in China live and work in a high-rise building with a basement car park. That is very important for EVs because you've got grid power at your fingertips. You can plug in as many EVs as you like, right? One of the big problems for EVs globally is rolling out the charging infrastructure, right? Suburban streets don't have thick enough power cables to charge multiple EVs, whereas in China, that's not an issue, major advantage. And the other angle, of course, is the government is really pushing the car companies on the EV side of things. They've got the new EV quota system this year where car companies have to sell a certain number of EVs. That's pushing them to launch more and more models. And obviously Beijing's also pushing them very hard in the technology side. So I think China, the EV story is going to be great. Right now, though, the EV sales numbers look spectacular, but if you look into the detail, not much of that EV sale is actually direct to consumer. Only about 20% of the EV sales last year were to consumers. The bulk of it is fleets, it's taxis, it's SOEs, it's government departments, or it's buses. So most of the EV sales today in China are things where the government is saying you must buy an EV to the people that they control. The actual direct sales to consumer, we're only still at the forefront of that, similar to other countries. But certainly everyone is launching new models. I do believe that market will do well. When we look at the EV raw materials, however, the supply has just come in way, way too early. Right. So through 2016-17, people were investing a lot of money in China, building battery facilities, building processing plants, and running around to secure supply. Now all those plants have switched on. We realize we've got too much supply. Utilization rates, a lot of battery plants in China are down at 30% levels. So yes, demand's growing 20 or 30% a year, but the supply is just horrendous. Last year, lithium carbonate equivalent imports, 215,000 tons, 83,000 of that went into inventory. 40% of lithium supply last year has gone into inventory. There's too much of it. That is not good for the prices. So obviously prices have come off a lot. First half of the year, we saw a lot of carbonate facilities switching on. So carbonate prices led the way down. Back end of the year, some hydroxide processing facilities are switched on. So that's been hurting the hydroxide prices. We're still seeing them coming down at the moment. So short term, we'd still expect prices in lithium to be moving lower. At some point, no, from an investor perspective, it's going to get cheap enough that you can look at that 5-year demand trajectory and say, okay, maybe now it's looking attractive. But short term, way too much supply, still think the pressure remains. Cobalt as well, another one which we still see it oversupplied this year and next year. Can't really get excited about that short term as well. And I'll just finish off on manganese. That's another very bullish story. That's one of the commodities, again, impacted by China's domestic mining clampdown. On top of that, we had the upgrade to China's steel standards last year. They have to use more manganese in rebar to make a better quality product, construction standards and such. So manganese ore imports last year in China are up 49%. Massive growth. And that is going to sustain, because fundamentally China's not producing so much domestically, demand has increased. The question is, where do they get the manganese from? Because there's very little in the way of new manganese mine supply growth. In South Africa, the majors, they have the deposits, they could build the mines. The problem in South Africa is the logistics, right? The rail network, the ports, massively overused. So the growth in manganese ore imports coming very much via stuff which has to be trucked over 1,000 kilometers across South Africa. That's obviously a very high diesel cost. So from that perspective, manganese kind of a derivative play on oil. High oil prices going to mean a very high cost curve. Lower oil prices, slightly lower cost curve. So yeah, in summary, it's manganese. Copper is the number one overall. We still like steel, iron ore, manganese, zinc nearer term. And the ones to avoid still very much aluminium, nickel, and the battery material space. Cool. If anyone's got any follow-up questions, do let me know. If you want a free trial to some of the reports we do, please do just flick me an email there, ian@smm.cn. And yeah, I'll take your questions separately. Thanks, Leah.